The way these things play out, these economic events that are recessions, they're always different, but they always seem to follow certain patterns. And those patterns are economic events cause human responses, which then cause other economic events, which then cause other responses. I just want to share something with you I put together last night and this morning that helps to explain what I think we're in the middle of here. These recessions almost always begin where something happens and then the stock market crashes. Last week, 10 years ago, 20 years ago, 30 years ago, all the way back to the Great Depression, 1929, it all seems to be that the very first human response to some kind of an event, okay, in this case, the event was the coronavirus, then there's a human response, and the first human response is the stock market. What happens right after that, that event causes a dive in prices in the stocks, and then the human response is that consumer confidence begins to erode, sometimes quickly, sometimes slowly, all right? But when consumer confidence erodes, people start hoarding their money, and consumer confidence going down leads to consumer spending going down, which leads to businesses that were already smarting from the stock market in many ways, probably. Their business confidence goes down because they actually see fewer people in the stores. They see fewer sales online. They see fewer people in the restaurant, whatever. Again, this is a general statement about recessions. Stock market, consumer confidence, consumer spending, business confidence leads to unemployment. A company's way of showing its fear and keeping its powder dry is not hiring and sometimes firing. So that's what that winds up down the line. And usually it's down the line, you begin to see unemployment. Then further down the line in this process, one of the human responses is, I don't want to buy a house. Way down the line, usually months and months and months, if not a year plus into one of these things, you actually have home sales declining. And when home sales decline, home prices eventually decline. And the way that feels is buyers are like, many of them are out of the market. I shared yesterday that in these deep recessions, you see a 35% decline in home buying activity, i.e. moving activity, right? Buyers say no more, I'm not going to buy. And for the 65% who are going to buy, they're not going to pay top prices. Time passes. Sellers finally say, I need to sell. My house is not sold. I have to reduce my price. And so home prices eventually go down. And then months later, they get reported in the newspaper. And all this stuff, this sort of cadence of events, response, event, response, event, response, takes place usually over a period of 1 to 2 years. As these things do wind up pacing themselves out. The stock market's first, and then all these other things kind of cascade from there. What seems to be happening here is what would have taken a year to 2 years is actually happening in 8 weeks. So the stock market tanked, and then 8 days later, we had a massive spike in unemployment. Okay, stock market tanked, consumer confidence got so scared, and we actually got told to stay home. So businesses' confidence went through the floor, unemployment went through the roof, all right? And the question people are having is what's going to happen with home sales? I believe what's going to happen with home sales, as you know, is that we're going to see a 35% decline in the amount of activity of people buying homes out there, which again would normally take months and months and months and maybe all the way through the fourth quarter before you saw that reflected in a reduction in home prices because the sellers would be stubborn. So they're stubborn and the home sales go down. Home sales are going to go down sharply. That 35% reduction is probably happening right now, not over the summer, but today, which means in April and probably certainly May and June, maybe July, the only houses that are going to sell are the ones where the sellers do capitulate and lower their price. So what you can expect to see in the next couple of months is there's going to be reports that say home prices are down 15 or 20%, but it doesn't mean home values are down. The knuckleheads who report on these things are going to have it wrong. It means the houses that have sold cheaper. And there's a difference there. When the timetable is this compacted, it isn't necessarily real. American Airlines lost what? 70% of its value? That company didn't lose 70% of its value. When it's this compacted, it's more driven by the human response to these things and the hyper tense nature of them because we're dealing with something that's not of this world, right? We're dealing with the pandemic. When you see home prices decline by 20%, the good news for our industry is that's going to wake a lot of investors up because it's going to be very clear. If you want to sell your home and you want to sell it in the spring and summer of 2020, you're going to take a discount or you ain't going to sell it. Now, if you wait until September, I think you're probably going to be okay. If you wait to 2021, I'm pretty sure you're going to be okay as a seller to get the price that you want. The point is, it's the same stuff, guys. It's the same stuff that I found out through research, and the research was reading and studying data and talking to people then saw the way it played out in the Great Recession. Now I'm seeing the way it's playing out right now, and it's the same shit. It's just happening in a tighter timetable. The question is, if this is what the recession looks like, the recession is only half of the story in any one of these situations. The Great Depression had a recovery. And when you look at these things, you begin to realize that it isn't just the Great Depression was the thing. The Great Depression and the recovery after the Great Depression, that was the thing. So what we think is very possible, even likely right now, is that the compression of the timetable, where the recession might have been a year to 2 years and the recovery might have been a year to 4 years. We've got a recession where it's all taking place in an 8-week period of time, and the recovery, the stock market, has a very, very strong potential on the other end of this thing to bounce, boosting consumer confidence, erasing the fear, consumer confidence, consumer spending, jacking back up again, businesses literally opening up. They aren't just slow, they're closed, okay? So when they open back up again, consumer spending kicks up, business confidence comes back, unemployment goes away. People are being laid off right now, and they're being furloughed, and they're being guaranteed their jobs back, many of them. Okay, that's what they're being told. I know people who've been told, like, look, go get the unemployment. As soon as this is over, you come back. That's different than we're having layoffs and maybe someday we're gonna hire people again, all right? And then home sales and home prices catching back up again. If you prepare for this, what we've been talking so much about lately is how do we make sure we focus on, if it's tight timing, let's get ready. There's a starting gun gonna go off, all right? Let's line up at the starting line. Let's do as much as we can over the next couple of months business-wise, but also knowing that all the effort that we put in right now sets us up that if there is a sprint on the other end of this thing, if the recovery is just as compacted as the recession, and it should be because it's part of the same thing, then those who are at the starting line waiting for the gun to go off are going to win.